Without further ado, let's get straight into it. In today's episode, you'll learn why the biggest players on Wall Street are dumping tech and loading up on the boring stocks, why the AI bubble might be a Ponzi scheme, and a small oil company backed by KKR that might let you ride along with private equity. Let's get to it. So I've been watching something very interesting over the past month and a half. And it's the kind of thing you won't notice unless you're looking at the right charts. Industrial stocks, XLI, are up 33% since the start of 2025. Basic materials, XLB, up 27%. Consumer staples, XLP, up 12%. Now compare that to the Nasdaq 100, up 16%. Let that sink in. Consumer staples, we're talking toothpaste and cereal, are essentially keeping pace with the Nasdaq. And here's the thing, almost all of that outperformance happened in the last 6 weeks. It went vertical. Meanwhile, everything related to AI and tech has been bleeding. That's not random, that's a rotation. Someone, and by someone I mean a lot of someones with very deep pockets, is selling FAANG and buying factories. Why would they do that? My read, they're hedging the AI bubble while betting on something much simpler, that the American consumer is about to get a cash injection. Between Trump's tax refunds, which this year will be 26% larger than any previous record, and the possibility of direct stimulus checks, there's a wall of money about to hit Main Street. And these whales want to own the stuff that Main Street actually buys. FAANG is at plus 10%. Your local factory ETF is at plus 33%. When boring beats exciting by 3-1, it's worth paying attention. Now, why would smart money be running from AI? Let me show you something. The New York Times ran this piece about OpenAI essentially running out of money. But the real story is deeper than that. If you look at Fidelity's data, the most representative AI stocks haven't quite reached .com levels of insanity by price to earnings. So degens will say, see, room to run. But here's the problem. There's another metric that matters more. According to GMO, one of the best value shops on the planet, roughly 25 to 30% of the US stock market by market cap is now trading at a price to sales ratio above 10. Not price to earnings, price to sales. That means investors are paying more than $10 for every $1 of revenue. Not profit, revenue. True startup land. And it gets worse. What Nvidia, Microsoft, OpenAI, and the rest of the AI sector are doing right now is textbook round tripping. They buy each other's products and services, often through intermediaries, which inflates everyone's revenue numbers simultaneously. Company A buys cloud credits from Company B buys AI chips from Company A, everyone reports beautiful quarterly numbers, and the merry-go-round continues. If you worked in compliance, and I used to, sort of, in a commodity fund, this sets off every red flag in the book. Round tripping is financial fraud. It's illegal in the US, the EU, and basically everywhere with functioning securities regulation. No auditor should be signing off on this without massive disclaimers. But because the AI bubble is the last hope of the American economy, everyone looks the other way. What is permitted for Nvidia is not permitted for the plebs, as they say. And on top of all that, the Supreme Court might be about to blow the whole thing up. Bloomberg Law is reporting that the Supreme Court has scheduled February 20th as the next opinion day. And one of the pending cases? The legality of Trump's tariffs. Now, the tariff money has already been spent. It's baked into every budget projection. If the court says illegal, give it back, and we're talking over $16 billion a month that importers have been paying, it's not good. Here's how the negative narrative could play out. 1. Tariffs are gone, so the budget is blown. All of Trump's plans, bringing back manufacturing, AI investment, stimulus checks, suddenly have no funding. 2. The new Fed chair everyone thinks is a hawk, he's not cutting rates anytime soon, so no monetary rescue either. 3. No stimulus checks for Americans. Consumer spending drops, economy slows. Now, with the amount of margin and leverage piled into QQQ and FAANG stocks, any serious negative catalyst could trigger the exact same kind of cascade we talked about in episode 1 with gold and silver. Different asset, same mechanics. Leveraged speculators hitting stops, forced liquidations, algorithms piling on. But, and this is important, you can just as easily construct a positive narrative. 1. Tariffs gone means lower inflation, which means the Fed can cut faster. 2. Lower tariffs work like a tax cut for businesses and consumers. 3. Trump losing this battle means the deep state stability crowd celebrates and goes long on everything. I have no idea which narrative wins, neither does anyone else. But the date is February 20th, and if you have open positions, you should at least know it's coming. 2 quick points on precious metals. First, Chinese and Southeast Asian markets are in their New Year period right now. A huge chunk of global gold and silver demand is Asian. So any crazy price action between now and March 4th, take it with a massive grain of salt. The adults are on vacation. Second, if the Supreme Court does kill the tariffs and the administration responds by issuing more bonds to cover the gap, that's rocket fuel for the debasement trade. More debt, more dollar weakness, more reasons to own gold. And even if they don't, the market will eventually figure out that spending isn't going down regardless of what anyone says. So the gold thesis stays intact, whether it's now or 2027. If you have existing positions, you can probably do nothing. If you're thinking of adding, just decide. Do you want to act before or after the Supreme Court ruling? Before means more risk, more potential upside. After means more clarity, lower upside. Different strokes, decide for yourself. Now for something I'm personally excited about. I've been trying to find ways to play the structural oil supply deficit thesis through actual stocks, not just the commodity price. And the problem is, big American oil companies are already priced for oil being much higher than it currently is. Look at this. Since January 2024, Brent crude is down 13%. But Chevron is up around 20%. Exxon is up in and around 40% mark. Someone already bought the dip that hasn't happened yet. So if you're late to big oil, you might be buying at the top of someone else's trade. Which is how I stumbled onto Crescent Energy, ticker CRGY. This is a second-tier oil company, and I say that with love. Here's what makes it interesting. Number 1, it's run by John Goff, a billionaire oil man who specializes in turning third-rate oil companies into something much better. This is what he does. Number 2, the anchor investor and wallet is KKR. Yes, that KKR, the private equity giant. Normally, you or I have zero chance of getting into a KKR fund, but Crescent is their only energy play, and they're proud of it. So buying Crescent is, in a way, buying into KKR's energy thesis. It's like when Jeff Curry and Carlyle were buying discounted Lukoil assets, except you can actually participate. Number 3, the dividend is fixed at 12 cents per share per quarter, roughly 4.6% at current prices. Everything else goes to paying down debt and eventually buybacks. So you get income now and capital appreciation potential later. Number 4, they're not idiotic about growth. Every acquisition must return at least 2 times cash on cash. No leverage, no McKinsey consultants charging an arm and a leg for mediocre M&A advice. Just Goff's oil expertise plus KKR's deal-making. And they cap leverage at 1.5 times EBITDA, targeting 1 times. Now, on the option side, I'll be honest, it's ugly. The 2028 expiration exists, but not on Interactive. The liquidity is horrific. The spread is so wide you could drive a bus through it. What is liquid is December 2026 calls at the 1250, 15, and 1750 strikes. Not ideal, but workable. And as always, any option position, mentally right off the money. Options are like hamsters. Emotionally vivid, but short-lived. Don't get too attached. That's it for today. The whales are rotating, the AI bubble is round-tripping itself into potential oblivion, the Supreme Court has a date with destiny, and there's a small oil company worth keeping on your radar. Good luck. Good luck investing. And take care of your loved ones.